You're very welcome to the afternoon session of the ICSH Social Housing Conference, Finance and Development, our virtual conference this year. So we had a very large attendance this morning, more than 250 people I saw at one stage. So this morning's discussion really focused on the immediate challenges of COVID and Brexit and the resilience of the sector. So this afternoon we're going to speak about the more long-term financing issues. My name is Frank Allen and I work in infrastructure finance. And of course, there's no infrastructure more important than having a proper home for people. So I'm delighted to be invited to hear and chair this panel discussion this afternoon. So the format of the session is that we have three outstanding speakers focusing on very different aspects of the financing of social housing. And we'll invite all three speakers, each speaker to give about an 8-minute presentation. And just warn you that I might just give you a prompt if you're running beyond your time. And so 8-minute presentation, and then we'll have a panel discussion afterwards. Now, during the presentations, the participants in the webinar are encouraged, very much welcome, to send in a message on the Q&A dialogue box, which you'll probably find at the bottom of your screen. So please send on any questions. And I'll be keeping an eye, and Aidan Clara, who the Irish Council for Social Housing, will be keeping an eye. And once the formal presentations are over, I hope that we'll have some discussion and to get challenged our panelists a little bit on some of the points that they may be making. So we're starting this afternoon with Sean Cremen. Those of you who work in social housing in Ireland will know Sean very well. He's the head of Treasury in the Housing Finance Agency. He's been there since, I think, 2014. But prior to that, he had spent many years in capital markets and indeed in the property sector, both here in Ireland and in Asia. So he brings a wealth of experience. And those of you who have borrowed from the Housing Finance Agency knows, how committed and how his expert knowledge of the sector. So I'll hand over to Sean, and looking forward to the presentation from Sean Cremen, Head of Treasury at the Housing Finance Agency.
Okay, thanks very much, Frank. It's great to have the chance to present today. I'd like to thank Donal and his colleagues in the ICSH for their kind invitation. It's great to get the conference up and running, and it's a great achievement to actually do that. So what I propose doing is I'm going to do a presentation, and I'll try and share it here now. Hopefully this will work okay. Okay, so what I propose to do is I'm going to start the presentation with just a very short animation which we recently posted up on our LinkedIn page, and I suppose it's mainly for those people who aren't too familiar with the HFA, and it'll give you a sense of what we do. So I'll just run it there, and hopefully it will work okay.
Everyone needs a place to call home. The HFA has been supporting the delivery of new homes since 1982. We provide a wide range of products at market-leading rates for development, acquisition, and the construction of student accommodation. New lending is growing quickly, exceeding €1 billion last year, increasing our total loan book to a record 4.
Okay, so that's just it's just to give everybody a sense of what we do in the HFA, a brief overview. And as it happens, we're coming to the end of our current 5-year strategy 2020. So what I propose to do is just kind of briefly, I suppose, share some of the outcomes of that strategy, our achievements, feedback we've received from our stakeholders, some of the key challenges which we're all facing, and then touch on some of the likely areas that we'll be working on over the next few years. Okay, so in terms of achievements, well, we've expanded our customer profile quite considerably. We now deal with some 25 approved housing bodies. It was 6 when we started our plan. We're significantly growing our business with local authorities, particularly through the Rebuilding Ireland home loan, which we were instrumental in setting up. And in addition to that, then we also support the higher education institutions, the universities, with their developments of student accommodation. We've also introduced quite a number of new products over the period, but I think in particular, I think the introduction of long-term fixed rates out to 25 and 30 years, I think that's been really transformative in terms of developing new business. By having these long-term fixed rates, it's helped the approved housing bodies to, I suppose, significantly de-risk their businesses. It's helped them to eliminate any exposure to rises in interest rates over the life of the projects. And particularly when we're operating in such a low interest rate environment, I think that's been absolutely essential in terms of growing business. And it's also allowed them to take advantage of the low rates. Of course, that couldn't have happened if we didn't have a strong funding base of our own. So we've significantly lengthened our own funding duration, and we work very closely with the NTMA, the local authorities, the European Investment Bank and the Council of Europe Development Bank, just to to create the necessary access and flexibility to funding to enable us to do the lending which we do. Competition is good as far as we're concerned. It's probably fair to say that a few years ago we pretty much had the market to ourselves. Less so now, certainly. There are more lenders and more investors active in the market, and we see this as a positive. We welcome it. We think it's proof that there is a viable market there for new lenders, and we think we had to develop that market and to grow that market alongside our colleagues in the AHBs. We will continue to be competitive, and we'll continue to, I suppose, keep them honest to some degree. But it's good to see new competition. Our engagement with stakeholders, we're told, has improved significantly over the past few years, both in terms of the quality of engagement, but also the types of engagement we have. And then finally, we're still a fairly small team in the HFA, but we've reshaped our structures. We've invested in employing people and services with particular skill sets to ensure that we can continue to have the capacity to manage and to grow the business. The next couple of slides then just give a picture of the kind of growth we've achieved over the past few years. So this slide shows loan approvals. And it shows the really strong growth we've achieved up to 2020. So we're forecasting by the end of this year that we'll have approvals in and around the region of 2.8 billion, accounting for over 15,000 new homes. So quite considerable growth in terms of pipelines. For 2020 alone, we're forecasting in and around 850 million of new approvals, and that's up from 680 million last year. So the pipeline is clearly, it's still very, very strong. The next slide then gives similar numbers, but showing the loan advances, and again, very strong growth here. Total advances we're forecasting by the end of 2020 will be close to 2 billion euro. that accounts for in around 10,000 new homes. And for 2020, we're forecasting by the end of the year that we'll have advances in around 700 million to approved housing bodies. So when you look at, and that's compared to 630 million last year. So when you look at that in the context of the year we've had and the challenges we've had, I think it's a really excellent achievement for all concerned, I have to say. Okay, in terms of feedback, so as part of our overall new strategy and strategy review, we actually commissioned Frank to garner feedback for us from a wide range of stakeholders. And not to embarrass Frank now, but he produced a really excellent report, I have to say. It was very comprehensive, and it's going to be central and will be central to the whole strategic review. And he's presented that to our board and gotten very, very positive feedback on that. So on the positive side, we're glad to say we're seen as responsive and professional. Our customers have described us as accessible, agile when necessary, and very importantly, and we think it's great to hear that they see us as a natural ally. Some of the I suppose the issues or the concerns that they raise are around funding diversification. We do have a large proportion of the market. And some AHBs are looking to diversify their funding, which is fine. Some other stakeholders have advised us that they're looking for the HFA to look at supporting non-CAF and non-PAA type initiatives, and that could be around affordability and environmental issues and things like that. Credit limits, a number of clients are seeking greater visibility around our credit process, and particularly around the allocation of credit limits and how we go about that. And then finally, some looking around further stakeholder engagement. So it's all very constructive feedback, I have to say, and we'll be taking these points and other points on board as we go through our strategy review. Some of the key challenges then which we're facing. So clearly COVID is a very major challenge, both for society, for people, but also around the whole area of development of housing. I would say from our perspective, we think that what we see so far is that the sector has managed it really, really well. The main kind of early impact which we've seen is really around delays in projects because of the closing of development, rather than any kind of massive cost claims or even cancellation of schemes. So I think, to date, I'd say the sector has managed it extremely well. Of course, there's still an awful long way to go, and we need to be vigilant and aware of difficulties as they arise. But I think it's a challenge which we can rise to. Supply. The demand for housing and the targets set for approved housing bodies, the targets they're expected to achieve, they're going to remain very, very challenging. And that's even just looking at the social side. There's the whole affordable housing, which is going to add to that. And affordability is obviously a key issue, both in terms of purchase and in terms of rental. And it's clearly a key priority and something that has to be addressed. Concentration risk, it's something we're facing and we need to manage closely. And finally then, just overall managing of growth. I think it's really, really important for all of us that, that we maintain the high execution standards, ensuring documentation is completed properly, that we have proper insurances, adhering to regulatory standards, that the whole kind of all the risk area, the credit risk management and all other risk areas, that you know, in the face of real pressure to deliver and to get things done, that we make sure that we do the day-to-day mundane stuff, that we do that properly and maintain the standards. I think it's absolutely key. Okay, and the final slide then, it's really just some of the things that we'll be looking at over the coming years, and will form part of our strategy. Not least of that is to keep doing what we're doing, and to stay focused on the delivery of social housing. But there's other areas there that we'll be working at with our colleagues in the department and elsewhere. So around the whole area of ESG, the environmental impacts and retrofits, financing and all that kind of stuff. Affordable purchase, affordable rental I've touched on, care worker supports or key worker supports, community housing, shared ownership, etc. So they're set out there, and they're the kind of areas that are on our radar and we'll be looking at over the coming years. So I think that's it from me.
Thank you very much, Sean. That's very helpful. 850 million euro in approvals this year is a very impressive amount, considering how recently this portfolio is being developed. So thank you very much for that. And we have more than 100 participants in the webinar at the moment. So I'm sure many of you will have questions for Sean, and do send them on in the Q&A section. And I'll now hand over to Robert Grundy. Now we're very pleased that Robert can join us. He's well known in the housing world. He's the head of housing investment and consultancy at Savills. And you know, any of us who have studied finance know that one of the first things you learn is it's the study of how to value an asset. And Robert has done some pioneering work with the Royal Institute of Chartered Surveyors in the UK to help people in how to value social housing assets, you know, in terms of their existing use. So for his contribution both in transactions and his intellectual contribution to the field, we're delighted that he can join us here today. So over to you, Robert, and to your presentation.
Thank you very much. Let me just, can you hear me okay?
We hear you fine. I think we need to...
can you see my presentation?
Yeah, all the slides are together, so you may do it individually. Start the slideshow.
Yeah, I'm just trying to do that. There we go. Yeah, I'm just trying to do that. Is that better? Can you see it now?
Can you expand the screen a bit as well, if that's possible?
Can you see that okay?
Yeah, that's fine. Yeah, let's go ahead now and try and maybe keep it around eight minutes if possible.
Okay, thank you very much. Well, I've worked in housing for about 40 years, started doing slum clearance in the poorer parts of Manchester, joined Savills about 30 years ago, where I was fortunate to be able to set up the housing consultancy business. And there we pioneered the loan security techniques for doing local authority stock transfers, which were 100% debt financed management buyouts in effect. So we had to really understand how to use housing assets as security. We then did a lot of work in terms of getting getting funding moving for conventional housing. And then I also invented existing use value social housing, which was a lot of fun for the nerds amongst us. So after talking to Donal and Frank, I mean, there's a lot to say here. I've narrowed it down, maybe a bit brave, but having a go at looking at how we take public housing assets off balance sheet. So I'm going to have a little bit of a cock shy at that. And then I'm going to talk through some key learning points. So let's crack on. Can we move funding off the public balance sheet? And this is, of course, in terms of HA borrowings, AHBs, and also council house borrowing, council borrowing. It's a big subject. I believe it can be done based on the strength of the assets, whilst at the same time continuing to meet policy objectives. Now, I'm no accountant and I'm not a regulatory expert, but these are my kind of simple tests as to can we move off balance sheet. It's about control. It's about the degree to which government provides support, income support. It's about ownership, and it's about the degree of underpin or guarantee. So I think, you know, I'll leave others to solve those problems. I've got a view on them, but where I'm coming from is it's all very well doing that, but is affordable housing fundable itself on its own 2 feet without government support? And I think the answer is yes. And the answer is to do with real estate backed funding. And it won't be any great news to you for me to say that it's going to be a mixture of debt or equity. Debt tends to be a much bigger player in the UK, and it has a number of advantages. It's simple, the markets are very, very deep. There's an established set of lending ratios. The borrower gets to keep ownership. It may be subject to all sorts of covenants and restrictions, which could limit your freedom of movement to do other things, and it's not suitable for all assets. For example, shared ownership isn't terribly popular. In terms of equity, this is much more recent, and we've got some vast untapped pools of capital who are showing a lot of interest to come into affordable housing at rates which can compete with public funding rates through a range of routes, either purchase or JVs and partnerships. The watchword is all about additionality, sitting alongside an RP or sorry, an AHB rather than supplanting them. It's often lease-based against specific objectives, can enable higher gearing in terms of the income, can be reversionary. Got to be very careful about the rent payment basis and the degree of indexation and whether or not you're locking yourself into a particular index over which you don't have control. And then there's a whole host of things about that itself in terms of the organisation, whether it's on or off balance sheet for the organisation. So part of the key towards establishing asset-backed lending is looking at what happens at default. And I believe that there are ways in which you can realise additional value above the worth of the asset for housing purposes. So it's all about the trade-offs between the restrictions applying to the asset and its underlying value. In the event of a default scenario, the role of the regulator is absolutely key to engineer a move or to engineer the where there's a defaulting organisation. What happens to that organisation? And I believe you can construct a series of structures based on strict definitions of default and preconditions of default, which are very, very rigorous. And if those triggers are breached, then one can access the underlying value of the assets unfettered by the restrictions that apply to affordable housing. And that doesn't necessarily mean that you have to sell completely. There could be an asset management strategy of gradually selling empty properties, for example. The key here is, of course, to protect residents' interests. And then finally, you could be looking at a disposal into the wider AHB market or into the, as a last resort, into the wider open market. I haven't got enough time to cover all that ground, but there's an awful lot to that there. If we just look at different measures of value and approaches to gearing, you'll see down the right-hand side of that slide, one can talk about market value, existing use value social housing, or something that's very new on the scene, which is market value social housing. And just to say that the loan to value ratios on existing use value and market value for social housing are much, much more helpful, shall I say, than those that are subject to market value. And that's because those valuations that reflect affordable housing are much less volatile. It's all about volatility. Market value is more volatile than a valuation basis tied up to affordable housing. If we, now, I'm sure there are some funders out there. Now, it's just great to see AIB, you know, having such a strong presence here. there may well be other sources of private finance in the organisation who are thinking about this as a market to get into. And here are some of the things that you've got to think about the income that comes out of social and affordable housing. It's incredibly stable. It's acyclical. It's not, it just keeps going. It's super boring and reliable. It's inflation linked. It's tied into wage inflation indirectly. You've got very low void and bad debt rates, fast absorption and stabilization rates. Now, those of you in PRS will know what that's all about. It's ethical. It very much plays to the ESG agenda. Demand is virtually infinite. It's highly predictable. And over time, portfolios of housing build up very strong databases of historic performance. So you can start to analyze performance on a kind of semi-actuarial basis, or especially at scale, which gives you some real leverage if you're trying to get credit ratings and so on. If we look at forms of subsidy, there are all sorts of forms of subsidy. The truism here that if you want subsidized housing, you have to have some form of subsidy. You can't just magic it out of the air. Although, funnily enough, the returns that some investors are wanting now, the implied cap rate from that is sufficient that they can pay quite close to market value. Anyway, I'm just going to focus on capital grant here, which is great because it enables a housing association to build up a store of equity for future gearing. Public land, and don't get me on public land, we need that to be released. And it's a massive tool that the public sector can use, providing it's set with clear objectives around the land and covenants attaching to it. And then if one is looking at local authorities, it may well be that you'd look at a reduced price for disposals, but that has to reflect the use of the asset for affordable housing. All of those are forms of subsidy, but nevertheless give you the key to being able to access higher value if things start going wrong. I'm just going to touch on regulation quickly. Here's all the stuff about regulation. I'm sure there are people in the audience knowing a lot more about regulation than me. What I would just say is there's a fine line, if we're moving off balance sheet, between control and influence. And we could have a discussion about that. What I would say is, in terms of the conduct of the regulator, it's a very, very fine balance between having excessive caution versus the actual risk. And I would say that affordable housing is extremely low risk versus the recovery mechanisms that you've got. And there are some really powerful levers that you can pull to get a housing portfolio back on track if things start going wrong. And the wider objectives. You know, we want to build loads of housing. And if you're too cautious and so on, if you get the balance wrong, then you end up not achieving your final objective. Here's my final slide here. Here's some key watch outs, key learning points to watch out for. I'll be sending the slide to the organisers and putting it on my LinkedIn page so you can pick through some of these. You'll spot some oxymorons in there. Best value procurement, design and build. I mean, they're just absolute pearlers if you start thinking about it. I mean, you know, we all know about overambitious planning gain, restrictive covenants that kill the ability to fund, and the same with loan agreements. We've already covered the regulator. What I'd say is, if you're looking at this thing, look both at rental inflation, but also cost inflation. Remember that rents and costs don't necessarily go up at the same rate. It's the rate at which net income increases that is super important here. And don't assume that your gross to net ratios here that you look at in PRS housing are the same. Cost is cost is cost. It doesn't cost less to manage affordable housing than it does to manage PRS. I think that's probably enough there, so I'll hand back. Thank you very much.
Well, thank you very much, Robert. You've touched on some very current issues in your presentation, and it's good that your experience in the UK shows that these are being dealt with. The release of public land, you know, that's very much on the agenda here with a new land development agency. The issues about what's the appropriate level of gearing, that's a subject that's of some concern by various people here. So look, I look forward to some questions about that. Anybody would like to submit some questions? I notice one question in already for Sean Cremen to think about relates to affordable rental. So Sean, you can be thinking about that before we turn to Dr. Brenna O'Rourke. Brenna is the Executive Director of RHL Strategic Solutions. RHL provide advice for investment decision making, and the area that Brenna I think focuses on quite a bit relates to how to make a sort of a non-listed real estate asset, how to make that more accessible and attractive to investors. And you know, anybody knows that if we're to attract more investment into the market here, it needs to be liquid, and there needs to be ways of doing that. And Brenna has relevant experience internationally in that area. So Brenna, over to you. I think you're on mute, and we're looking forward to your.
Hi. Hopefully you can see my screen.
Yeah, very good. Thank you.
Great. Okay, so really what I'm just going to run through is the role of institutional investors who have been increasing their appetite for all forms of residential investing globally, and particularly in Europe. Just to put it in the context of institutional investors, and what I mean by institutional investors are pension funds, insurance companies, and to some degrees, sovereign wealth funds. They invest around 12.3% for pension funds and around 11.2% for insurance companies in terms of their overall assets under management in commercial real estate. Commercial in this sense being it is a commercial use, so it includes much of their residential investments as well within that remit. It's commercial in terms of the investment. Around 8% of this is invested directly, but they also invest through funds and through non-listed REITs. What I want to emphasize is that their strategies focus on core investment. And what I mean by that is income. So they're focused on generating long-term income and achieving a return. Real estate and residential within that are very attractive to institutional investors because it can, if structured appropriately, give them a very similar income to a bond, but gives them that uplift of return, which of course is also important in the current low interest rate environment, which has been ongoing now really since the crisis. And they really need this to be able to deliver on their asset liability management models. So,
if I may interrupt you, could you go to slideshow because people can't quite see it? So if you could just go to slideshow in your presentation. Great, that's much better. Thank you.
Okay, sorry about that, everybody.
Great.
So the real focus here is on generating this long-term income stream. And in terms of sectors, the investors have also, the institutional investors have been turning their attention to residential, but also towards broader alternatives, which to some degree can be termed residential within the residential family. So that also includes the private rented sector, social housing, student accommodation, and to some level senior housing, which is often also part of healthcare. They look at these across an investment matrix because real estate forms part of real assets or part of the alternatives. So increasingly, the largest investors have moved away from having distinct silos of an allocation to real estate, an allocation to infrastructure, an allocation to private equity and fixed income. And they're tending to look at those now more together within the house of real assets and looking at a more matrix approach, which makes sense because clearly a senior income debt product is more similar to core income focused real estate than it is towards to mezzanine finance. But this has also allowed them to be more flexible in how they allocate. So if you take affordable housing or you take social housing, it's partly infrastructure, it might be partly debt, and it might be partly real estate. So it allows them to be much smarter about how they're allocating across those portfolios. What they really like about residential is that it tends to be a really good diversifier within their wider portfolios. So it's grown from being around 6% of portfolios of European institutional investors' portfolios pre-crisis to now, and particularly growing since 2015, to being around 20% of portfolios. That now makes residential the third largest sector that institutional investors invest in. And really, I think most people expect that by the end of this year, it will have moved to second place, as with retail values falling. So it really has matured. In certain markets in Europe, it was always a major market. Residential has always been the largest market, for example, in Germany. And so different institutional investors from different markets take a different approach to it. So I've said some of this already in terms of why are institutional investors attracted to residential. They're looking at long-term strategies, particularly post-crisis. The institutional investors have really refocused on megatrends. They're looking for assets that are dislocated from short-term economic cycles. So moving away from cyclical pricing and moving much more to long-term strategy anchored to these megatrends. Clearly, there is great demand for housing across many sectors of the residential sector going forward. And they're looking at how they can access this and develop long-term, secure, often inflation-hedged income that they can use as for duration matching. Within residential, they don't necessarily allocate, they do allocate to individual sectors, but it all becomes part of a broader living strategy increasingly for these institutional investors and their managers, so also the investment managers. So really we're looking at long-term annuity incomes. And also for these investors, it offers a really good capacity for impact investing, and institutional investors, I'll come to it later, are at the forefront of ESG agendas, and they've really been spearheading those on behalf of the industry since 2004. What holds them back? Regulatory certainty. Institutional investors don't mind regulation, they quite like it, but if they're looking at investing over a 25-year horizon, they don't want shocks. If we take items like rent control, they're actually not opposed to those. So if you look at some of the large Dutch investors investing in this sector, they aren't looking to match to market at every turn and get the highest price. They want sustainable communities. They want a sustainable income flow from affordable housing. So rent controls aren't such an issue. They want to engage with the regulators, and they very much engage with their stakeholders and with their managers. So it really is a partnership model. From their point of view, they say it makes absolute sense for them if they're universal investors. So from their point of view, if they want their investments elsewhere, either in equities or in bonds or in other commercial assets within cities to work, then they need to be able to supply them with the right type of community, the right type of skills, etc. And so it becomes part of the whole for them in terms of a holistic approach to overall management of portfolios. And this is really, I think, for me, a happy return to the role of the universal investor that was probably put on the back burner in the early 2000s, but is very much back as they refocus on these long-term trends. They need scale, as mentioned already. Management is expensive, it needs feet on the ground, and it needs dedicated personnel. And so scale of investment is important to be able to create economies of scale and efficiencies to make it work. They also need the market to have some liquidity. They need more, they don't want to be the only player in a market. They need to have a market that has other active investors in it. How do they invest? We've said 8% invest directly. And really, I'm conscious of time because I do want to get to some of the models. So what I will say here is there's a polarization in the market between the very large institutions, the very large pension funds and insurance companies, who in these sectors are very much looking to invest directly, often through joint ventures, not with other investors, but with other operating partners or managers. And then the medium size and smaller size are unable to do that. So they will invest through funds with large scale investment managers who are also polarizing in size. Increasingly, there's blurred boundaries between the investment managers and the investors, as even some of the large pension funds take on third-party capital that looks very like them. How do they invest? Well, it really depends on the product, it depends on the market, it depends on the risk, and it depends on an individual strategy. But from earlier work that I did on behalf of IMREV actually very recently, it was published 2 weeks ago, we looked at this at the operational real estate market, so looking at student housing, healthcare, senior housing, etc. But you can also apply that to the residential sectors to a great degree. So they either invest through debt finance, supplying a long-term senior loan or whole loan. They may do it through leasehold, so a straight lease to an operator or to a manager or affordable housing supplier or social housing provider. Or they may do it through a management contract, very much working with a joint venture partner who may be their operating partner or their manager, who they will pay to manage the asset for them, and they may pay a small performance fee if certain hurdles are hit. Some other large institutional investors are also looking at more shared entity models where they also take a stake in their joint venture partner, as well as the joint venture partner having a stake in those. They tend to be a good test model for the relationship itself, but there are some issues with them, and so some institutional investors have also moved towards a holdco model. So essentially, this looks in structure like a private equity model. The real focus here, though, is on developing a long-term sustainable income stream over 25 years. So I think, for me, often when you hear private equity model, you tend to think high risk, high return, quick cash out. This isn't what these holdco models are. These holdco models are about building a long-term sustainable income with a partner and generating scale. There is no focus on cash out, and certainly very little focus on capital growth. Depending on who you are, whether you're an insurer or pension fund, your ability to move in these different models varies. Insurers are subject to the rules of Solvency II, and that very much tends to limit them more towards the debt finance and to some extent to leasehold, because Solvency II impacts on their capital allocations and capital weightings, etc. Pension funds aren't subject to the same constraints. Looking at from the stakeholder's point of view, or looking at from a provider's point of view, why invest with an institutional investor? You know, if it's good for the institutional investor, is it good? Would it be good for the provider? I think they are, because they are long-term capital seeking an annuity income. And certainly in other sectors such as student housing, and particularly within healthcare, nursing homes, etc., there's been a real, I think, marriage between the operators and the institutional investors, because you're not looking at short-term capital that is going to end in 5 or 7 years, or a fund that is looking to cash out of 5 or 7 years. So it allows for very long-term strategic planning. They're true partners. So even with the debt and traditional leasing, these institutional investors stay in very close partnership with the operator or manager. They recognize that even, that they may have a lease and they may have an obligation, there may be a rental obligation, but that rental obligation will only be made if the venture is successful. And so they stay very focused on it. And it does also impact on their own resourcing of this. And that's one of the reasons that they need scale. This is much more resource intensive than investing in an office. They've got depth of investment and finance experience. They can bring much of that to the table, and there's potential to derive great benefit from that. They're experienced in all stages of the development process, and increasingly the institutional investors want to be in this from the beginning, so more focused on whole loans than senior loans, and more focused on forward sales necessary than development funding, so that they are there from the beginning. This is partly if they believe that if they are signing up for 25 years, they want to take the early return, which is higher as well. But it's also, I noticed from institutional investors that I spoke to that are looking at student housing and more emergent markets in Europe, said actually they want to be in it from the beginning because they want to make sure that the quality is right, that they don't want to be purchasing assets from more opportunistic developers who may be in it for a shorter term horizon and may be less concerned with the durability of the asset. So they're also concerned about the quality. I've mentioned their role as universal investors and their focus on ESG.
You have many more slides, Brenna?
Sorry?
You have many more slides?
One.
Okay, very good, great. Thanks.
Okay. So just on the ESG, because I know that's of interest, just the role of institutional investors. They spearheaded this by signing up to the UNEP principles in 2004. Really, by the global financial crisis, they had also already introduced clear measures, the GRESB index, on the basis of what measures gets done. But it was still a secondary objective, so they might buy an asset and then look at how they overlay ESG on it. I think what's really changed now as we move into the latter half of this decade is that it is absolutely integral to everything they do. It's a primary objective. It's in there at the beginning of a purchase of an asset. They're not interested necessarily, they want to green the asset, but their focus is on making an asset as good as it can be. And they are now measuring the improvement. I think really, without going into the detail of it, they have environmental done, they know what they're doing, and they're continuing to improve that. But their focus now is very much on social impact investing. And of course, affordable housing and social housing is an area where they really can have a strong measure of their social impact. Social impact isn't new for commercial real estate, it just hasn't been measured before. Actually, that was my last slide. The third one, because I think this also gets lost within, and I'll finish on this, when we talk about ESG, we talk about the environment, we talk about social impact, and everyone tends to forget about governance, possibly because people aren't really sure what it means in terms of how you measure that. But institutional investors are governance in itself in terms of their own policies, their adherence to their policies. And certainly if you look within the senior housing industry, particularly assisted living and nursing care, their level of governance and their involvement in that sector is very much improving the delivery to stakeholders, and it's improving the adherence to regulation. And I think that is something they also bring with them.
Very good, Brenna. Thank you very much for that. Now, we have about 120 people participating at the moment, so I'm looking forward to some contributions from the floor, as it were. There's a consistent theme that has come across through the presentations. It's clear from what Robert says that this is an asset class that's attractive to investors. It's boring. It's the sort of thing people want to provide finance for. Brenna tells us that there is a large community of investors that wants to pursue this market. So there's money out there that is chasing after this business. And Sean spoke about what I would regard as a reasonable volume of transactions, certainly on the HFA side. Having said all that, is it fair to say that there has been very little institutional investment in social and affordable housing in Ireland to date? So my question to the panelists, and maybe to the floor as well, what's necessary for the social and affordable housing sector in Ireland to access what is clearly a large source, a pool of investment funds that's there. Maybe I'd start with you, Brenna, to say, what are the things that should be done by the sector today, so that if you were to come back in a year's time, you'd hear about several transactions that had attracted institutional investment. There has been private investment, private debt in particular, but I think it's fair to say there has not been a lot of institutional investment in the sector.
Yeah, I think the approach to the sector varies across Europe, as you'd expect. Social housing varies across Europe, and therefore the participation varies. But I think what it needs is a regulatory framework that is open, transparent, and shows transparency. I also think that if you compare, say, particularly Germany, to some extent the Netherlands, with the UK and Irish lease laws, which are quite similar in some of their structures, but not all, then I think that there needs to be also a greater focus on long-term occupancy. So within the UK and Ireland, and I say and Ireland obviously has rent control measures, the UK to date doesn't, but the lease frameworks tend to be more investor friendly rather than occupier friendly. That is not the case in many of the other European markets, and rather contradictory. That is potentially less attractive to the continental European investors who are seeking to have a sustainable community and develop sustainable communities on the basis of having long-term occupiers. They don't want high churn. They're not looking for a 6-month rental contract. They're looking for people to establish communities. So I think there's an aspect of that. I think there probably also needs to be scale. There's a little bit of first mover here as well, in terms of those investors coming in. You need 2 or 3 large investors to be active in the market. Just to give you an idea of resource, and this is only on research, when I was interviewing institutional investors in regard to the other operating incomes like student housing, for example, one of the larger multi-management platforms had doubled the size of their research team from I think 6 to 11, with that extra resource, and a third of the existing resource entirely focused on these new operational sectors. They are more resource intensive. Another investor told me that they had one asset where they hadn't invested through funds, and that took 1.5 FTEs to manage that asset. So that gives you an idea of the degree of scale that's required to create economic efficiency.
One question from the floor is, what sort of scale of transaction would be required for this to be attractive to an institutional investor? And a related question is, how do people access institutional investors? Is there a gap in terms of the intermediaries here who could mobilize it? But on the first question, what sort of scale of investment would be required for it to be attractive to the clients that you have, the institutional investors who are interested in this type of risk?
Well, it will be dependent on how big their existing platform is and how diverse that is already across Europe, or whether they're focused on one market. But I would have thought that you need, if you're looking for one person to come into a new market, then you're probably looking for 300 to 400 million as a starting place.
For a single transaction?
Yeah.
Okay, that's a considerable size. Sean?
Robert, I don't know if Robert disagrees with that. He's active.
I was just sort of pondering on that. One of the key things here is scale, because one of the things about affordable housing, as I said, is it's incredibly nerdy, and it has, even as somebody very, very familiar with the UK market, the Irish market has a whole set of acronyms that you've got to learn. Mm-hmm. So to get into a market, you've got to really want to get into this market as an investor and spend the time to learn about the market and really get into it. So to that extent, if one is going to be really creative, then the scale has to be there. I would really agree with Brenna. Whether it has to be 300, my experience is probably about 100, but that's in a more simple kind of market. If what I would also differentiate between is there's in essence bond issuance, where you get all the pension funds and so on investing very heavily in that, and differentiate that between more direct investment, where there's a more direct investment in the real estate. So now the bond issuance thing, I think the barriers to entry are probably lower. You need somebody to structure the whole thing and make it all work, but as an investor, it's much more straightforward. You're dealing with more of a commoditized product. Whereas if you're trying to create something, create a new community or structure a joint venture or a partnership, then that's a much more involving process. Where I think, maybe you don't get the scale up front in the first transaction, but let's say you could come along and co-invest in somebody's program, the 5-year program. What's not to like about 50 million a year or something like that of investment potential?
Robert, a related question has come from the floor is, someone has asked about what is the shortest and perhaps more importantly, the optimal length term for an institutional investor getting into social housing, and if there's a lower return on investment expectation or a yield. So this is getting into the more detail of the transaction, but what are the expectations of an investor in terms of, the financial returns and the maturity of the investment? Do you have a sense of that?
Yeah, I mean, I would say a minimum of 30 years, maybe even longer. But once the reward there is the returns that you get are much, much lower. The number of bright-eyed, bushy-tailed people that we've come into our office saying, oh, well, I think I'll accept as low as 5%. You kind of say, well, come back in a few years' time when you're being more realistic. One has to be looking at sort of 3.5 to 2.5 at the moment as sort of the levels, or even in very few circumstances, even less than that. If one can present the asset in the proper kind of way. Now that has the effect of deterring some people, but this is where you get to, you've got to get the scale.
Okay. Sean, would you like to?
Yeah, Frank. I think we should kind of bring it back into an Irish context and looking at, say, the AHB sector trying to access institutional investment. And I think you have to look at where we're coming from or where the sector is coming from. So, as recently as 5 years ago, 6 years ago, AHBs weren't raising debt. Okay, everything was funded on a grant basis, Yeah. So they've come. I think the sector has come, and particularly the larger entities, have come a very long way in terms of their professionalism and their financial management and that. So I think they've made huge strides, but it's not something you don't walk into institutional investment and debt markets quickly, So I think the next step might be looking at kind of private transactions or one-off transactions for AHBs to build up their expertise and get used to working with particular investors. I think public bond issues and that kind of thing, the scale isn't there, and that's a big step up.
Could I just jump in?
In terms of getting debt ratings and building up prospectuses and all of that sort of stuff. So there's an awful lot of challenge in terms of accessing these markets. And I think from an AHB perspective, it's really, it's step by step, and they've come a long way. And probably the next step is to start doing smaller transactions. But it's going to take time. And these things, you know, they add a fairly significant burden to the AHBs in terms of transparency and selling their product and being able to explain the processes and the plannings and everything like that. So it's a pretty onerous process that they need to build up towards. It's not something.
Okay, Sean. Well, okay. I think I understand that point, and I see another comment has come in from a participant saying, recognizing that to leap to a stage where you have the full-scale institutional investment with custodians, investment managers, and liquidity may be a huge leap at this stage. Is there an intermediate step? Is there a way of accessing private funds in some way, some sort of a platform where that might be more in keeping with the scale of transactions in Ireland? And, you know, I suppose it's fair to say a large number of participants, a large number of approved housing bodies in the same market. Is there a way to come up with a platform to acknowledge that there is a desire for diversification and funding, but maybe we're not quite ready for the fully fledged institutional investors to provide 30-year facilities at €300 million a transaction?
Can I jump in on that?
Yes, Robert. Yeah.
I mean, I think I share a lot of Sean's pain there in terms of what he was saying, and there are issues in terms of how the market builds up. So to answer your question, Frank, one of the routes may be the creation of an aggregator. You know, it would be, you know, if you look in the UK, there's THFC, the Housing Finance Corporation, which was specifically set up to be able to provide access to bond finance for smaller housing associations, where people may have been individually borrowing tranches of 10 or 20 million, but there may have been 20 or 30 of them all under the umbrella of the aggregator. So Sean, there's a challenge for you to maybe see if you couldn't set up an aggregator and provide that scale.
Yeah, and that's something that has been discussed from time to time. The challenge around that then, Robert, is you know, the THFC they're a fabulous organisation, right? But they do impose pretty strict financial covenants on the underlying AHBs, which the AHBs in Ireland don't face at this point in time. You know, so they have asset cover of 150% or something like that. So they're very, you know, there'll be additional constraints and restrictions to the businesses that the AHBs will have to face. And I think in the UK as well, you know, most UK housing associations have fairly large, if you like, older unencumbered books that generate good cash flow and that they can borrow off. Whereas the AHBs here, you know, their back books, even if they were unencumbered or even if they are unencumbered, they're actually not generating any cash. You know, they're generating differential rent, which isn't sufficient to raise finance on. So there's, you know, there's pretty big differences between the Irish market and the UK market, and I think the aggregator thing it's an idea, but it again will bring its own challenges for the AHBs here, which they haven't really had to face before. I think it's desirable that AHBs do start stepping up into the kind of the capital market space, but I think it's got to be a really, really measured and careful process, I have to say.
Okay. One of our participants has actually suggested here, thank you to Eddie McGowan, to say, asking if the panel sees a role for aggregators. So I think you've anticipated that. Now, another detailed response has come in, and I'll read it out because I think it's very useful. It's Jim O'Leary has pointed out that one of the reasons why institutional investment has been slower in Ireland is, he says, that there has been a slower than anticipated regulatory reform, that the scale of investment is that the deal size isn't big enough to cover the fixed costs associated with a transaction, and that to date that the Housing Finance Agency has satisfied the needs of AHB. So Sean's doing a great job, doesn't need anybody else. Though, as Jim points out, that there is movement in all three of those areas, and that maybe, you know, next year we will see the possibility of more diversified sources of funding, which people are looking for a range of reasons. Can I ask the panel, and maybe ask Sean this, somebody's mentioned it in advance, whether you feel that, as you know, we're very likely to be entering into a serious recession today, that the constraints on exchequer funding is going to force the sector more into identifying alternative sources of long-term funding, that the demand for housing will remain, but maybe the availability of cash from a cash-strapped government might make it more difficult. So do you think that changing economic circumstance will make a difference here, Sean?
Yeah, I mean, that's always hard to say, Frank. You know, we don't know what's going to happen in terms of state finances. I suppose if you look at the housing body sector, they're pretty much totally on balance sheet now. So any borrowing which they do is going to be captured in the general government balance as well. So so there's no particular advantage in terms of, say, us borrowing and lending to an AHB and an AHB borrowing directly from a third party as it stands at the moment. The sense we have, I have to say, at the moment is that any funding we require, we have access to, and there's no sign of any difficulty in terms of accessing finance. But you know, in the circumstances we're in, that clearly could change. But whilst AHBs are on balance sheet, there's no real difference to them borrowing or us borrowing. You know.
Okay. There's been a question from the floor, Robert, to see, was there a particular trigger or what motivated the sector in the UK to move from bank debt to institutional investment for social housing? How did that evolve there?
Well, I think there isn't a particular trigger that's motivated that move. It's more, in many ways, the sector itself is very resistant to change. They're more than happy with being able to raise finance at incredibly cheap rates. I think what has happened, though, is that we've had a shift in the institutional market, as in the direct institutional investor market. As I say, institutions have been present from the very beginning in investing in bonds. So I think what it is it's more the institutions getting realistic about the rates of return that they're prepared to accept. And it's very interesting to hear what Brenna was saying about how, you know, the relative growth of the resi sector compared with other sectors. You know, at the rate we're going, residential real estate and affordable housing will be the only game in town in terms of a way of investing reliably in real estate. And so, you know, with those investment returns beginning to look interesting and sensible and competitive, then one is in the early days of that happening. The thing that I would really caution, though, is to be very, very careful about leases and the way in which you enter into a lease and the obligations that you enter into and the degree to which you underwrite an index over which you have no control. I think we're in a position where investors are beginning to be prepared to take indexation risk based on the length of time they're prepared to invest on, based on the fact that they know that there'll be a long-term trend in income inflation. So I think it's really a change in circumstance which has led to this.
Very good. Okay, now I'm looking at other questions that are coming in, and I appreciate that from various people. Changing the subject slightly, there's been a question here earlier on, Sean, about affordable rental. Do you see movement? What sort of transactions are likely to come to the market to respond to that need?
Affordable rental. So I suppose any kind of affordable rental model, it's probably going to be based on cost. So it'll be a cost-based rental model, I would expect. So if you look at the components of cost, it's around the build costs of the property, and then the financing costs over the life of the transaction. So whatever model is produced, I think, to use Robert's phrase earlier, if you want subsidised housing, you have to provide a subsidy. So we have to look at the components of an affordable rental model. It's the building side, the cost of construction and all of that, and the cost of finance. So the subsidised supports have to come in either at the front end or through the finance, or more than likely a combination of both. And I think that's where it'll come from. I think whatever model we produce, it has to be sustainable. So it can't just be a model that works in a very, very low interest rate environment. It has to be something that works over time. And I think, preferably if we can come up with a model that does attract institutional investors in some way or other, I think that would be very important and very advantageous for the model.
Okay. I'm reading some other contributions from the floor. There is a question from Rushad Nariman asking Sean and Brenna, what do you think, maybe I'll put this to Brenna, the average benchmark lending rates in the social affordable housing sector, and how could a private finance company participate in the sector for a period of 5 years? Brenna, would you like to respond to that? 5 years a bit short for people to be thinking about.
That is a different model to there's space. I don't think in social housing, but certainly in the private rented sector, there are, as you see it in your own markets, there are space for shorter term models. They tend to be more focused on capital growth than income growth. That tends not to lend itself to affordable housing, and certainly doesn't lend itself to social housing. So from that point of view, I think there's room for that model in the market, but it's probably not in this space.
Okay. There have been a few questions about the whole issue of balance sheet classification on and off balance sheet, which is a subject of much interest. Here, one comment here says that there's a perception that the sector's reliance on HFA may have been a contributing factor in terms of that decision, and perhaps the opportunity to access alternative funds might help to move away from on balance sheet. Now, Robert had identified some of the key characteristics that would allow transactions and the sector to move off balance sheet. Is there much happening in that area, Sean, do you think?
Well, first of all, that's the HFA financing being one of the reasons why AHBs moved on balance sheet. That was kind of touted, I think, about 12 months or so ago. I think it's been proven clearly that that's not the cause for them to be on balance sheet. And even if all the financing was coming from other sources, that they wouldn't necessarily get off balance sheet. The principal reasons for AHBs being on balance sheet is around control and around where the revenue comes from, etc. So it's not necessarily the funding from the HFA. There's a fair bit of work being done around this. I think it's going to be quite challenging to get AHBs back off balance sheet, but I think it's certainly worth the effort. My sense is that, as I said earlier, in terms of ongoing funding, while AHBs are on balance sheet, there's certainly, we're not seeing any sign that there'll be any slowdown in terms of funding for AHBs while they're on balance sheet. Now, clearly, that can change over time, but certainly at the moment, we're not seeing that.
Okay, very good. Thank you for that. Changing the subject to something else that Robert had mentioned that has been discussed here in Dublin quite a bit, and that's the appropriate level of gearing, and related to that, the regulatory control over that. Is there, I know, Robert, that you yourself had very active role in coming up with appropriate valuation for assets, which will be, you know, very important in terms of coming up with an established way of calculating gearing ratios. Is that, would you have any comments as to what would be appropriate levels of gearing in a sector that has been growing very rapidly here? Is that an important aspect of access to alternative sources of finance, for example?
Well, okay. Well, we're trying. You were hinting at the growth point there, and whether it causes a problem. I think it really comes down to the fundamentals of demand. If you when I visited Ireland and particularly had a look around Dublin, my impression was that there was a big problem in terms of the supply of affordable housing. You know, the affordability problems are just the same as in many other leading cities around the world. You know, if you take San Francisco, Vancouver, Shanghai, Sydney, London, the affordability problems are the same. So in that context, what you have is a very big differential between people's ability to pay the market and people's incomes. So in that sense, one has an inexorable demand for this. And especially in an economy that needs key workers and people that work in maybe not the best paid industries, but nevertheless really important industries and really important services. It's massively important that they have good quality housing. So if that's the context, then what one has is a product where market volatility really doesn't apply to the performance of the rent. It goes up steadily, and you know, when the market's booming, guess what? People can't afford to house themselves, so they go into affordable housing. When the market's in decline, their jobs are not so secure, so they get some kind of income support. Guess where they go? Into affordable housing. So for all of those reasons, what you have is an asset class where the value volatility is just not the same as in the market. It's a much more smooth progression. So whereas in the market, you may have loan to value ratios that could be, say, 60, 65%, even maybe on a good day, 75%. One can look at loan to value ratios here, 85%, 90, 95%. And that reflects all of those characteristics. Now, what one has to recognize, though, is that that level of value is not at the same level as the market itself because of the restrictions that apply to the asset and the constraints that apply to it. You know, being only able to charge certain levels of rent, being regulated, certain standards of management, and so on. So that's the key to be able to achieve those very high gearing rates.
Brenna, would you have any view on that? You know, in the community of investors that you're most familiar with, you know, the non-listed real estate vehicles, would that sector have a strong view? Are there requirements there in terms of leverage that would be very important in terms of looking at Ireland as a place to advance funds?
Well, it's interesting. Institutional investors try not to use any debt at all, particularly pension funds and insurers. So it would be all equity, or if they're looking at providing a debt loan, then they tend to be quite conservative. So whether you talk about that being 8% on what you might qualify as the market price, or 90% on what you might qualify as the price reflecting the restrictions, then they would tend to probably be slightly lower. Same for the non-listed funds, who of course, you know, their principal investors are institutional investors. I've just run some figures for an industry organisation and updating a report, and the average European non-listed debt over the 2017, roughly the same figures. It's around 22% in terms of the gearing level on those funds. So it gives you some idea of how, you know, some higher, some lower. The level of debt's really fallen in terms of It's not a big driver of the real estate market anymore. Of course, it needs to be there, it needs to facilitate it, and it can enhance returns to a degree. But it's not the driver of returns that it was, and we know in 2005, 2006, 2007. The point I suppose I'd like to make is, that there are the needs of the stakeholders, but there is an underlying need for supply across the market. So whether you take that in terms of social, affordable, or that segment, and I think this is interesting. This is where institutions in the Netherlands and Germany are really focused, is on that segment of the market where people are earning slightly too much to qualify for affordable housing, but are certainly unable to pay the market rents for the PRS sector. And I think we all acknowledge that there's a huge swathe of the market in that segment who are probably the first generation of they're working, they're in professions, but they're unlikely to ever make it onto the housing ladder, as it would seem. And they need housing solutions. That is an area where the institutions are focusing their affordable housing models. So it's not necessarily in the social housing space as such, if that makes sense. I think it's also what you qualify as affordable. There's definitions within your own industry, and then there's wider definitions in terms of where those hurdles meet. If the institutions come into that part of the market themselves, it also takes pressure off the existing affordable housing market, and therefore then onto the social housing market. And the real key is to see, how do we actually meet the demand, the need for the housing? And I think potentially institutions can come in and deliver to a segment of the market that's really falling between two stools at the moment. And that could be really beneficial. I think the other side is to, and I know that's not the focus of this conference, is that the other aspects that come into this are from public policy. And I think there's a real job here to be done with planning and covenants and restrictions on the land that is released. Because we heard earlier about the shorter term private equity model. When you're looking at a 5 or 7 year return, you're always going for the that in Dublin market at the moment, going for the private rented sector, and the higher end of that sector is undoubtedly going to generate you the highest return. But if there are restricted covenants on the use of the land in terms of who it can be targeted at, then that brings those land prices back down. It also takes that element out of the marketplace and allows you to expand that. And I think that's a real area of focus that is, and I'm sure you're looking at that, but it's aside from finance, but it's almost more important.
Okay, now, in fact, participants in the conference would be interested to know there's a whole section tomorrow morning dealing with that exact issue about housing affordability options. So it is very much a live issue here, because that gap between people who are on the housing list and people who could afford the open market is a widening gap. Sean, do you see opportunities coming forward that would be able to access private funds, institutional investment, debt, international debt, that could mobilize those funds to address that increasing share of the market?
Yeah. On the affordability side?
Yeah.
Yeah, I mean, it depends how it's all structured, Frank. And as I said, it has to be a kind of a sustainable model. And it has to be, if you can achieve a vehicle of some sort that you can build affordability around, I think then there is possibility for attracting institutional investment. As Brenna said, these investors they're looking for long-term sustainable income. So if the scheme if it provides the subsidy to provide the affordability at the outset, and then the investors get certainty of income over a lifespan, well then certainly I think they could be attracted to it, But again, it comes back to the whole scale issue, and if we're going to achieve this, we will have to achieve it in scale.
Could I just
sorry, Robert, yes.
Yeah, if I may just come in very, very quickly on that. I mean, just to support what Sean was saying there. I think we're in an interesting position where if you look at the yields that people will want on PRS, that investors want on PRS, and the sort of the capital value that's produced by multiplying one rent, one by the other, it's quite interesting to see that. I believe we're at a sort of a point where investors are beginning to understand this market, this sub-market affordable housing, where in this gap, where it's really people in really good quality, reliable jobs who don't have a choice to get into the open market, where the rent produced by those assets will be very reliable and share many of the characteristics of what I was talking about to do with social and pure affordable housing, and hence be prepared to accept yields that capitalize back up at figures that are not too unadjacent to what PRS assets are worth. So it begins to be a competing asset class, I think.
Okay, well, I think we're coming to the end of the session, so maybe I'd like to draw a little bit of this together. My sense is from the contributions of our three panelists and some of the contributions from the floor as well, is that there is a sense that there is a real need to diversify the source of funding for social and affordable housing in Ireland. So the demand is there. My sense is that even though the scale of the transactions may be smaller than what might be observed in the UK or elsewhere, there probably is an opportunity for certain investors to come in for a smaller scale transaction and who recognize that this is a stable environment, regulatory and otherwise. So what appears to be, where there appears to be a gap still, is to find some sort of mechanism, the intermediary, who is it that should be putting together the type of transaction that meets the demand and meets the supply, and does the ICSH have a role in this? Who should be taking the lead, taking the advice that you all have been given here today? Who should be taking a lead in moving forward in achieving a greater diversity of funding for social and affordable housing in Ireland? Mm. I might ask all three of you, but Robert, would you like to?
Gosh, well, I think you've got to take. You've got to take, as I think as Sean was saying, you've got to take baby steps. I mean, that's an incredibly difficult question, Frank. I think that you've got to overcome these scale things and so on. You can create a really nice shop window. I think if you can simplify things, if you can simplify regulation, take away uncertainty to do with that, take away policy risk and so on, then I think a lot of those barriers, you've got to get the scale low, and the scale is perhaps a problem. Now I may have an answer there, which we haven't touched on yet. Sorry if I'm going slightly off track here, but that's local authority housing. And what actually broke the market in the UK was local authority stock transfers, okay, where you could you've got a ready-made lump of scale. Then you've got some first-class quality assets that are incredibly reliable. You've got fantastic data, and so you can do you can almost rate those transactions in terms of the scale of data that you've got. You've got the scale there. So with a little bit of work, I think that what you could get, that could be the start of the market. That would be how I would do it.
Very interesting. Brenna, would you like to contribute anything to this? How we move this forward?
I think that as an industry, you need to decide what it is that you're looking for, and with that, shape out how that could work in a transparent regulatory framework, and then go to clear intermediaries or go through the ICSC. I know that they already have strong contacts across Europe, and have the conversations with the institutional investors who are flexible, will have a framework that they need to fit around, and then through that conversation find a model that works. Remember that they also have their own regulators, so your models will need to fit with the models that they can present to regulators in terms of their own balance sheet, impact on their own balance sheet. And then with that, I would look towards public policy with the institution in arm.
Yeah, very good. Sean?
Yeah, I suppose I'd argue, Frank, that it is ongoing and it is being looked at and it is being considered. I mean, the department, I know, are all over this and very, very aware of all the issues. So I think there is an awful lot of work being done on this in the background, and you know, I'm sure that will continue. But I'd argue that it is very much being looked at.
Well, look, it's a credit to our three speakers that we still have well over 100 participants on an afternoon listening to detail of institution investment in social housing. So I'm not surprised. We got three great presentations, and thank you very much. We should thank the AD and people in the ICSH for making all this smooth and seamless. We didn't have to think about technical problems and all that. So thank you all for that. And and to AIB for continuing to be a sponsor, you know, an important source of funding, both for social housing and for these conferences for the ICSH. So tomorrow morning at 8:45, do check in because Dole McManus will be welcoming you, and there will be a session chaired by Sharon Cosgrove of Oakley about affordable housing. What are the options? And I think that would pick up very well from some of the things that were spoken about this afternoon. So thank you all very much. It's been an excellent discussion, and looking forward to further discussions tomorrow and Friday. Okay, thank you all very much.
Thank you.
Thank you.
Thanks, Frank.
Cheers.